They say only two things are certain in life: death and taxes. Well, if you're a DeFi investor, you can add a third to that list: hacks, flash loans, and risk management. And today we're going to talk about them all. Welcome to our channel, the #1 place for crypto education. And here we explain topics of the cryptocurrency world using analogies, stories, and examples so that you can easily understand them. In this video, we're going to be explaining what flash loans are. We're going to tell you why almost $1 billion has been lost due to them. And we'll also touch upon some other ways that people lose money in DeFi, like rug pulls and simple mistakes. First off, let's start with the old school way of losing money. Back in 2016, there was something called the DAO hack. DAO stands for Decentralized Autonomous Organization, and it was basically a smart contract that held Ethereum and allowed investors to pitch ideas and vote on them with their EIP tokens. Well, one idea or exploit was coded into the contract, and that exploit allowed someone to take 3.6 million Ethereum, which at the time was about $50 million. After this happened, the Ethereum community actually split into two different chains. One continued on as Ethereum, and the other, Ethereum Classic, kept a copy of the funds being stolen in the blockchain. This is important to show that even the smallest exploits can have major consequences, and this is one reason why investors need to be extremely careful about which projects they invest into. And then after that, in 2017, there was another exploit. This one was called the Parity multisig bug, and it affected a popular wallet that held $185 million worth of Ethereum. Now, one user accidentally triggered an error in the code that put the funds into a state that couldn't be recovered. Basically, it locked up all of the funds and nobody had a key to unlock it. Nobody, not even the creators of the wallet. This goes to show that sometimes even when your money is stored in a well-known and popular project, it's still susceptible to loss. Now, this was before flash loans became popular, but flash loans would only make things worse. So what exactly are flash loans? Well, in order to explain that, I need to explain something else first. You see, in regular finance, if you want to borrow $1,000 from a bank, you'll need to go through many hoops. They'll ask you for your credit history, run a credit check, get collateral, set up a payment plan, etc. But on the blockchain, it's a little bit different. On the blockchain, there are services like Ava and Compound where you can deposit your Ethereum or your favorite token and earn interest on it. And when you do this, you're essentially lending your money to others. For example, if I lend my money to one of these services, they might turn around and loan it to someone else who wants to buy an NFT. That other person would then use their purchased NFT as collateral. And then someone else could come along and take out a loan against that NFT's collateral and so on. So you can see how all of these complicated financial instruments are made possible through smart contracts. Anyway, back to flash loans. With flash loans, a user can borrow a large amount of Ethereum or other tokens and trade with them, but they have to return the same amount back in the same transaction. This may sound confusing, so let me try to break it down with an example. Let's say I wanted to short squeeze an altcoin. I could do this by borrowing a bunch of USDT from a flash loan service and then selling it for the altcoin. Then in the same transaction, I would sell that altcoin for more USDT and return the USDT back to the loan service. If the price of the altcoin decreases during this process, I would make money. Now, in theory, this sounds harmless, but in reality, it actually caused a lot of havoc. First off, flash loans allow traders to borrow hundreds of millions of dollars worth of Ethereum and other tokens. Like in one attack, someone borrowed about $300 million worth of Ethereum in a single transaction. Now, when a trader takes out a flash loan, it allows them to move the market price of the asset that they're trading. This means that other traders could come along and think that the price is increasing naturally, so they might want to jump in and buy that asset too. But it's really just a flash loan trader manipulating the price. So in reality, it's like a constant tug of war between flash loan traders and normal traders. But enough about this tug of war. What actually happened during DeFi summer of 2020? Well, one day a bunch of different traders began exploiting different protocols and draining millions from them. And we mean like tens of millions in a single hour. These attacks weren't because of slow transactions or server crashes or DDoS attacks. It was pure manipulation through simple code. This taught the community that we need to assume that everyone we interact with on the blockchain is a potential attacker. We can't assume that anyone is trustworthy. And we need to build our own systems based on assumptions that are as true as the laws of mathematics. For example, we can't assume that just because a certain protocol is audited by a third party that it's safe. There was an example in the Ethereum DeFi ecosystem where two separate auditing companies said that the protocol was safe. But a few months later, it turned out that the protocol wasn't safe at all. Two big companies messed up. So instead of relying on third-party audits, maybe we should focus more on learning about the tech ourselves. Another thing that can cause huge problems is weak tokenomics. One of the most famous examples of this is the Squid Game token. Squid Game is a TV show where a bunch of players compete in games to win a prize. So the show has its own cryptocurrency and its own NFT collection. Well, unfortunately, the Squid Game token is a perfect example of bad tokenomics. It had a very small, fully diluted market cap of $2.7 million. This meant that the price of the token was mostly determined by whales, and it didn't take long for them to find this out. On October, the price of the Squid Game token was sitting around 2,800%. And you guessed it, the whales dumped their bags, and the price plummeted to 2,700%. This taught the community that we need to research the tokenomics of any project that we invest into, and make sure that there aren't any glaring red flags. Next, I want to talk about rug pulls. This is when the creators of a project run away with the investor's money. Usually a rug pull is executed by stopping development on the project, halting withdrawals, and then dumping any unsold tokens that they have. Even though this doesn't involve bugs or exploits, it's still important to talk about because rug pulls make up 39.9% of all funds lost in a decentralized exchange scam. The best way to protect yourself from rug pulls is to avoid investing into any projects that don't have strong teams behind them. Finally, let's talk about one last way that people lose their money on the blockchain, and that's by making simple mistakes. And by simple mistakes, I mean not reading the fine print or not understanding how something works. For example, a while ago, a hacker stole $130 million because someone accidentally approved a malicious contract. To avoid this, always read the fine print and understand what you're getting yourself into. As you can see, there are many ways that people can lose money in the cryptocurrency and blockchain space. But don't worry, because as long as you stay educated, you should be able to spot any warning signs. With that being said, I hope you enjoyed this video. We really hope that you've learned something, and most of all, we hope to see you in our next videos.